Welcome to the ninth in a series of presentations that have been developed as part of the Plymouth College of Art and Atlantic Youth Creative Hub's Creative Entrepreneurs Business Incubation Programme. This programme has been designed to support young creative entrepreneurs by providing the fundamental skills required to develop an idea, plan and start a business, and ultimately take their products or services to market. Through a series of workshops, events, and mentoring, participants increase their business knowledge, gain confidence to start a new business, and develop their professional practice. My name is Mark Cotton, and I've produced this series of presentations to capture and share the content of the AYCH workshops, creating a resource for future reference. Getting the money right is fundamental to running a good business. In this session, we explore how an enterprise successfully manages its finances from cash flow to budgeting, forecasting, and cost modeling. So you've created your business model, developed your strategy, you understand your vision and your mission, you've refined your value proposition, developed your service or product, you know what the resulting social impact is going to be, and you've started to generate some interest in your business. Now you need to do your sums. Keeping accounts for your business is essential to see if your idea is going to work financially. It's a fact that many startups, new social enterprises, fledgling companies won't make a profit until year 2 or even year 3 of operations. So spending more than what comes in many situations, is inevitable. What's important now is to be strategic. You need to know what the deficit is and how you will plug the gap. How will you ensure that you are financially viable, even when not making profits or generating a service? Your business has a much better chance of being sustainable in the longer term if you're diligent with your finances from the beginning. Setting a strong financial foundation is crucial to success. Know your numbers. If you've set up as a sole trader, you'll initially need to register for self-assessment with HMRC. If this is your chosen legal structure, then it's also helpful to set up a separate business bank account to help avoid personal and business spend getting mixed up. Any tax payable will be due when the self-assessment deadline comes around. The tax year runs from 6th of April to the 5th of April the following year. You then have until the end of January the year after to submit your self-assessment tax return. You'll then pay income tax and national insurance payments as a percentage of your trading profit based on the annual tax bands. This is different from pay as you earn, which, as it suggests, is where you are employed or salaried and pay income tax and national insurance as a deduction from your monthly salary. So if you're a sole trader, if you're self-employed, you're always paying your tax in arrears. Therefore, it's really important that you get into the habit of setting aside a proportion of your income as savings to meet a future tax liability. How much income tax you pay in each year depends on how much of your income is above your personal allowance and how much of your income falls within each tax band. Some income is tax-free. The current tax year, running from the 6th of April 2020 to the 5th of April 2021, the standard personal allowance is £12,500, which is the amount of income tax you do not have to pay any tax on. You then pay income tax at different levels depending on the level of taxable income you're earning. These levels are the same regardless of whether you're a sole trader submitting a self-assessment tax return or a salaried employee on pay as you earn. If you've registered as a limited company, maybe as a community interest company, you must file annual accounts with Companies House. The yearly financial performance of your business must be presented in a formal record and in a prescribed format. And the due date for submitting accounts depends on your accounting year. For limited companies, you can more or less choose your accounting year to suit yourself and your business, but you still need to complete and file accounts annually with Companies House. You'll also need to file a tax return with HMRC to find out how much corporation tax you're liable for. This is a tax on your annual profits, and all UK limited companies pay this, and it's currently charged at 90% on any profit generated. A corporation tax return must be completed with tax due for payment to HMRC within 9 months and 1 day of the accounting period. Irrespective of your business structure, and this includes sole traders, you must register for VAT if your annual turnover is £85,000 or more. Registration is optional if turnover is below that. VAT is essentially a tax on sales and basically means you will charge your customers at the standard 20% VAT rate, which means that you must add 20% to your sales price and then keep this amount aside from what your customers pay you. You will then be able to reclaim any VAT that you have paid on business-related purchases and expenses, and then you pay the net difference to HMRC. VAT returns and payments are due on a quarterly basis, and all VAT-registered businesses with VATable sales above the annual VAT threshold are now required by law to keep digital records and file digital VAT returns through compatible software. Many businesses that go bust are profitable but have hit financial problems because either the business owner doesn't keep up to date with the finances or because they run out of cash. Cash flow problems are the biggest killer of small businesses, with recent research showing over 70% of small business owners seeing it as their biggest threat. The key to avoiding financial problems is having regular cash flow forecasts, effectively a chart or spreadsheet showing for the next year at least how much money you were paying out and how much money is coming in each month. A good habit to get into is to make sure you have at least 3 months of cash available so you can ride out a bad time or an unforeseen problem. This is particularly important as sales increase. Many businesses go under from overtrading because they incur lots of upfront costs from having more sales and they hit financial difficulty before the payments are received. This is particularly the case with businesses that have high upfront overhead costs. It's also a big danger where you have a large client who insists on paying slowly. The average wait for some sectors to get their invoices paid is 69 days. Meaning that you will have to carry the materials, the staff, and the VAT costs for at least 2 months before you receive the money. This is quite a burden on any business. Making sure you regularly monitor your debtor days and getting it down as low as possible will give you the most possible cash and security. The two main ways you can reduce the amount you are owed are to firstly get as much money in as early as possible from your customers. Thinking about how you can get more money up front is critical. Thinking about what you can do, such as asking for an upfront deposit or billing in phases rather than at the end of a piece of work, might just be the difference between surviving or failure. Secondly, be really hot on getting people to pay on time and be organized with your reminders and chasing. With online bookkeeping software, you can often automate this so it happens quickly and efficiently. Creating a budget and cash flow forecast is a vital part of any business success. A budget and cash flow forecast will help you keep track of your finances from expenses to profits. It will enable you to answer the questions: how much money do I have? How much do I need? And how much do I ought to be making? It's also worth noting that investors and bankers may also want to see your budget plan before investing any money in your business. You will need to predict or project your sales. And there are various different costs that you will need to take into account in your budget, such as the cost of goods sold, which is the direct cost associated with the production and supply of the goods or services that form your sales income. Then there are fixed costs, costs that don't usually change and are charged monthly or annually, such as salaries, rent, mortgage, and insurance. Variable costs. These are costs that may change from time to time. Your variable costs will be spent on materials or supplies that you need for your business. And then there are one-off costs. These are challenging to predict, but an allowance for these can ease pressure when something unexpected requires money. These costs can vary from replacing a broken computer to repairing a vehicle, for example. It's important that once you have created your budget, that it's updated on a regular basis. Updating the budget with actual costs from the previous month and reviewing the cash flow forecast going forward to ensure that you have enough cash available to meet liabilities. This will allow you to see where your business stands in terms of its finances. You can always come back to your budget plan, especially when you need to see where you can save your company money in the future. Having an estimation of total cost and sales will allow you to make a prediction on the profit margin that you should expect. One of the things you'll need to get right very early on is the pricing of your goods and services. Knowing the true cost of something will help you with the pricing. Know what you are worth. Most people totally undervalue their worth and the value of their product or service. If you price yourself cheaply, people's first reaction might be to ask what's wrong with your product or service. Understand your costs. You need to figure out the true and full cost of each product or service and how much does it actually cost to produce something. The materials, the design cost, the production, the distribution cost, the packaging, the marketing, the advertising, and the point of sale cost, etc. Think about what your product or service offers, its key benefits and qualities, and then do your pricing. If you know your value and your worth, it's not necessarily about what your competitors are charging. Make sure the price is right. Be really thorough about working out prices so you build in everything to ensure your prices cover not just the basic inputs, but also a share of your overhead costs and also a profit for yourself. You can use a number of different pricing methods, such as break even. This is the absolute minimum price you ought to ever charge. It's typically the position organizations that have grant funding are in, as they receive money to cover the project costs, but are never in a position to make any surplus on the grants. With the cost plus method, you take all your costs and then you add a percentage on for profit. Typically, you'll want to aim for a profit of around 20 to 30%, as this will give you money to reinvest in your business and also to develop new products or services. Then there's competitive or going rate, typically used when your product or service is broadly similar to that of your competitors. Petrol stations, for example, when one increases their price, they all tend to follow. Penetration pricing is where you set a low price initially to secure a high volume of sales. If you're selling high volume, low cost items, this is a good strategy, as even though you may only make a few pence on each sale, you'll be selling thousands every day. The opposite of this is price skimming. This is ideal for products with short life cycles, such as computers or mobile phones or games consoles, where you have a high price but sell low volumes initially. And these products, they always appeal to the person who has the latest gadget or phone and are prepared to pay a premium rather than wait a couple of months until the price comes down. Prestige pricing is where customers are prepared to pay more for a higher quality of goods and services. And then value-based pricing is largely defined by the benefits and the qualities of the product or service. So for example, are you selling own brand bread, or are you selling premium bread, or the organic seeded artisan sourdough bread? Each of these is targeted at customers who value and pay a certain price based on the perceived value and quality of the product. Finally, try psychological pricing. $9.99 instead of £10 always seems so much cheaper for some reason. Pricing too low is one of the biggest mistakes you can make. I often hear social entrepreneurs saying, we need the work. Let's set really low prices so that people buy from us. The pitfalls of this decision are that you won't be able to cover your costs and you'll go out of business. Or you're positioning yourself as a cheap budget product or service, which devalues your offer. Or you attract price conscious customers who are not loyal and will drop you as soon as you look to increase your prices. And it's very difficult to raise prices in future as people come to expect a cheaper offer. And then there's no room for negotiation. Finally, if a customer won't buy from you, it can be tempting to offer a discount to get the work. But by agreeing to a discount, you might be saying that your product or service was overpriced and not worth what you originally said it was worth. Thanks for taking the time to watch this presentation from the AYCH Creative Entrepreneurs Business Incubation Program. Please join me for the next in the series. Goodbye.